Hi everyone, this is Rob Roy of Elliott Wave Options, and welcome to this trade review of trade ID number 91 on the SPY in our volatility strategy, as well as some general market commentaries. You can see that this alert has been going on a while. It's in the adjustment process, but it is on the market in general as well, hence the reason that we've had this adjusting and going on for quite some time. I want to focus on these last three adjustments 7, 8, and 9. If we go back to November 14th, when we made the adjustment following November expiration, we continued this case study by adding just a long call to capture this expected continued move of the S&P in not only this wave 5, but also a zigzag, which I'll show you in more detail here in a second, up to the expected target around 313. And that's exactly what has happened. So here's where we are now. There's where we were set up to go to that target price, and in today's trade we've pretty much reached that target, close enough. And so now it becomes interesting as to where we go from here, hence the reason that we made the adjustment into a strangle for the last part of this adjustment. This will be the last adjustment on this case study. It's getting a little bit long in the tooth, but boy, are we set up for a potential decent move in either direction. So looking at the particulars here, a couple things to note. First of all, there's the zigzag that's labeled, as I promised. There's A. The B was a 61.8% correction, and now we've got our 100% extension in the C-Wave. So it couldn't have been a more classic Elliott Wave zigzag pattern with a mono A, a mono B, and a complex C. So just textbook Elliott Wave right here. Now what happens? That's the key, right? So we've hit this target price. Now look, we've had a pretty good run here, almost an unabated move from the very beginning of October to the target price without any sort of a decent correction in that time frame. Now, the Elliott Wave rules state that, for one, we could go to this 161.8% extended level and have an extended wave C. That's very normal in the course of Elliott Wave analysis. However, what normally happens before that, to have an extended wave, you usually come down, not every time, but a high percentage of the time, you come down and test the previous fib level, which would be that 61.8% level, which also note happens to be a major area of support before you go up and create an extended wave to the next target, an extended impulse wave. So the way it looks is that regardless of whether or not we move to the new high or not, that we should have some sort of a correction, at least back down to the 61.8% level in the near term. There are instances where you go straight up to an extended level, but it's such a small percentage of the time. The prudent thing to do was to take that small gain in the straight call, made about $100 off that, and then go ahead and set ourselves up for what's likely the next bigger move, and we have plenty of time for that. Remember last year, December was not a very good month. We're moving towards the end, as hard as that is to believe, of November now, and it sure looks like volatility is going to increase over the near term. So I wanted to update you on not only this trade alert, but where we are in the market in general. Thanks for your attention. Look forward to talking to you again next time. Take care, everybody.